All right, people, welcome back. It's TraderXO again with a one-off stream. Hope you're all well. Just give me a quick audio check that you can hear my voice okay and that you can see today's screen. How is everybody? Hope you're all well and that you've had a prosperous Q2. End of June, we're going to be heading into Q3, the summer months. It's going to be, I think we're really in for an interesting year ahead, especially with the Fed now dropping forward guidance. I think we are probably going to see a shift in volatility over the coming months. There's still some pessimism in the air, and there's still a lot of hope that the markets can continue going higher. As for Bitcoin, it's been fairly subdued, but are we at a key turning point? I guess we'll have to see over the next few months. All right, fantastic. So as always, anything said in today's stream is not financial advice. It's just, you know, kind of a real honor to get somebody who I've got a lot of respect for, which is Kieran, who's ventured off, you know, into systematic trading, and he's been absolutely crushing it. You know, he's got positive returns since his portfolio's gone live last year in 2025. So I just want to give a warm welcome to Kieran. Are you there?
Dude, you are so kind. Thank you for the warm welcome.
No, you're welcome. Thank you for coming onto the stream. It's been long overdue. I know you and I have been in conversations for the best part of, the last 6 7,
months?
8, 9 months. Yeah, and
yeah.
It's been inspirational watching your journey, you know, from your stats on Darwin X, and just to see you grow into really honing and crafting your skill into the world of systematic trading, which is never an easy jump, you know, looking on the outside in. But before we proceed further, we just want to make sure that audience, can you hear Kieran okay? I've always had a few issues with the audio. I just want to make sure that everything is working fine today. I'm just waiting for the confirmation in the chat, and then we'll kick off with today's stream. I think also a few of you are asking me about the live streams. I probably will come back with a stream, I don't know, maybe in July or August, covering Bitcoin in depth. It's, like I said, there's not really been a great deal to talk about on Bitcoin since my last few public streams, where I talked about the fact that give me February's high, I'm looking to become a seller. Obviously, I'm not going to talk too much about that. That's essentially what's played out. We're now back into February's low, where I said equally on the stream that it's around this zone where I'm looking to become a buyer of Bitcoin, or potentially prospectively looking for longs. But I think we're still letting price develop around these lows, around about that 59, 60K level. I don't know, is it going to be another lower high into 65s, or are we going to finally see a rotation back towards the mid-range of 70K, and then we'll have to see what happens. But without further ado, thank you for coming on board, Kieran. Pleasure to have you on. How are you?
I'm very, very well, my friend. It's a pleasure to be here. Bit of a humble moment for me, as I said on X earlier. You know, I have followed you for a long time, XO, and it's super humbling to be here joining you today.
Yeah, awesome. No, thank you for that. It's always great. I think the one aspect that I love about this entire trading space and the trading community is, you know, there's always a segue or a pathway to interact with other traders. Everybody is generally forthcoming or willing to have discussions, you know, and it's just, like I said, for me, I've always been intrigued about systematic trading, but I've never made that big plunge until the last 2-3 years. And even then, it's been very, very gradual. I'm not somebody who's a fully systematic trader in terms of automation, but I do use parts of systematic trading when it comes to dynamic stop losses, right? One of the reasons why I started using dynamic stop losses is because I was so peeved off with giving so much back to the market, especially in overnight positions, and that's something that I've come to develop over time. So it's kind of like a hybrid of where I am right now, but obviously for me, the next logical progression is to make that plunge over to not only just being a discretionary trader, but really operating a fully systematic, automated trading system. So hopefully we will try and pick your brains today and kind of understand your journey as a systematic trader, from where you were and how you managed to bridge across, because I understand you were also in the world of discretionary trading for several years, right? So why don't you talk us through your background and your history of, you know, trading in the financial markets or the crypto markets, because you do also happen to come from not just a TradFi background, but crypto markets as well.
I do indeed, man. I first started getting involved in markets back in 2017. I think Bitcoin at the time was sub 10K. Ethereum was $100 or so, like the good old days. My dad actually got me into crypto, rung me while I was making a long drive up to Manchester, and basically explained the Bitcoin white paper. And that was kind of my first entry to markets. I wasn't necessarily trading, but just, buying and holding, doing some intraday swaps, which I thought was trading, but I was just basically swapping one spot asset for another. And a couple of years later, or about a year and a half later after that, I stumbled across FX and started to dive into, actual intraday trading. Very early on, I realized that there was something to it, found some good guys to follow, yourself included, XO, and really dialed into, becoming a trader. COVID was massive for me. It was a huge period of time where I think I was the first person at the business I was working at to be furloughed. And I just said, right, it's time to go all in. Like I've had a couple of years to kind of build my knowledge base. And now it's time to put foot on the gas, which I did, right? I was working, 16-hour days, just learning and implementing. And I did that for many, many years, basically trading subsets of the same strategy, tweaking little bits here and there, testing new things out, kind of along the way. And more recently, stumbled across systematic trading, but systematic in a way of automation, right? As you've said, XO.
Yeah.
Finding ways to automate different parts of the process, and that goes kind of outside of just the execution as well. Trade management, idea generation, or hypothesis generation, as I like to kind of call that, idea generation phase. Every aspect of what I do now, I ask myself, can this be automated so that I can, put my focus elsewhere? On top of what I do as a trader, I also work at DarwinX. I'm the head of UK growth and business development over there. So I really get a good insight on kind of the other end, or the other side of the market. I'm speaking to relatively large allocators on, a recurring basis. I speak to LPs, brokers, hedge funds, other great traders just constantly. So I feel really blessed and really humbled to be in the position that I am, because I'm just surrounded by other great people, who I learn so much from, which is kind of why I think I said this in the stream I did with Matt earlier last week. I said I believe massively in paying it forward. And, I never really had anybody other than one close friend to guide me when I got into systematic trading. So I'm really trying to pay it forward now, and give it to the next generation of systematic traders in one way or the other.
No, I think that's brilliant, and I think it's great, because I think one of the most difficult aspects from my own experiences of systematic trading is, where do you even start? You've got those who have highly accredited degrees and PhDs, and they're very quantitative, mathematical, stochastic-based models. It's a completely different world. And I think the one thing that I really realized from talking to you is that it doesn't have to be as complicated as what it's maybe perceived to be. The second aspect is that, from listening to so many podcasts over the last 2-3 years since I've ventured into understanding systematic trading, is the best systems are often the simplest of systems. Is when you have, perhaps maybe you could argue, too many variables in a system. It could just add unnecessary noise. What I'd like to actually do, in fact, before we just go into the next question, the one aspect that I actually want to talk about myself, when I think about systematic trading, if I could go back now to day one as a trader, like blank slate, I don't know anything about trading. Yes, there's a level of education and a steep learning curve that you have to go through. Not only is it just about understanding price action, the technicals, the volume, maybe you want to understand order flow, but that's just the technical aspects of trading. What I think, or what I believe, is that I really wish I had an understanding of what it really means to have a systemized way of trading, not just journaling your trades, but really how do you measure your own performance? And therefore, you have some degree of control around variance, right? Because how often do we see, especially in the world of crypto traders sharing the charts, whenever you see people talking about swing fails or sweeps of the highs and lows, which seems to be the only way that crypto Twitter trades nowadays, is wait for the sweep. That's fine. But then you see a complete randomization of just put your stop below this low. I'm sure it works to some degree, but the problem with that approach is that, well, how do you actually measure the performance of that over 100 trades? It is a large degree of randomness to an extent, or let's not say it's just randomness, but it does have a high degree of variance. Whereas systematic, perhaps an approach would be, okay, if price is in a range bound and it's taken the range lows, I'm going to place my stop at the second standard deviation of the weekly VWAP. You can repeat that over 100 times, as opposed to stop at some random low. So I think that's really one of the ways in which systematic trading has made me think about the discretionary aspects of my own game, because all of that really feeds back into your journaling, and therefore your journaling now has a higher qualitative and quantitative amount of data that you can actually move forward with over a rolling period. But what I'd like to do from one of the first questions that I want to ask you is that you wake up one day, Kieran, you decide to get into systematic trading. Looking back now, what advice would you give to somebody who's never really looked at systematic trading? Where should they start? What should they look into? And what are maybe some of the misconceptions that they should just not ignore, but don't overthink or overcomplicate matters more than they need to be?
So it's a really great question, but it's really difficult to answer. And the reason why it's difficult to answer is because I've been doing this for just over a year and a half now. My track record started in April last year. But I'd spent a few months before really trying to dial in on systematic trading and kind of building the automation behind that. My advice now would be very different to if you'd have asked me 6 months ago even, or 12 months ago, because the longer I do this, things are changing from a technology standpoint and an infrastructure standpoint, but I'm also, I might have a good record. I might have been successful, trading, but I still am a student of the market. I am still learning, and in 3 months' time, my advice might be different again. But as of right now, if you are on day one and you're kind of lost and, a little bit overwhelmed by the shift, go all in on AI agents. Like, when I say all in, I mean absolutely all in, because they fill the gap for everything, right? And I don't want people to misconstrue this, and I guess it kind of answers the part of your question where you said any kind of what do you say? Any kind of misjudgments or whatever the way you worded it is. AI won't do the job for you, but it's a way of being far more efficient at what you do. I'm sure we can get into why I say all of this in a little bit, XO, but the way that AI is developing now and the tools that we have at our disposal is just absolutely incredible. And somebody who hasn't kind of deep dived it, you will be blown away by some of the stuff that it can do. But the reason I think it's so incredibly important is because you can use it as a learning tool, right? Because I'll be completely honest, there's not a lot of education out there really that you can go and kind of look at for systematic trading. A lot of it feels a little bit gatekept, and kind of very hush hush. Whereas you could go on YouTube and type in best trading strategy, and you're going to find 1,000,001 different influencers saying that they've got the best 15-minute strategy that's going to change your life. Systematic trading or algorithmic trading isn't quite like that. Yes, there are some people who educate, and yes, there is some content you can find. However, a lot of it is self-taught, and I am heavily self-taught. I also have 7 years of discretionary experience coming with that. So it's not as if I started on day one with no knowledge of the market, but I still started with no knowledge of systematic trading. But what I've done, and it's worked really well for me, and I've kind of doubled down, tripled down, and in fact, we've actually had a conversation about this recently. Is kind of building a second brain using AI, and going back and forth with a topic. So even to this day, if I read something and I'm like, I'm not quite sure what this phrasing means, or I'm not quite sure what this word is, I'll ask my agent. My agent will give me a response. I save that response in a directory or an encyclopedia that I have, and it's there for me to refer back to at any given time. I can use that in something like Notebook LM, for example, where I can get it to test my knowledge, and so I can just continuously learn. What you don't want to do is fall into the trap of kind of ignoring all the new phrases and terms and just hoping that you're doing the right thing. If you hear something like Sharpe ratio and you don't understand what that is, ask an agent. It takes seconds. Save that response. Check it later. You constantly want to be learning. And so to kind of round off the answer to that, I think you need to go all in on AI agents and just focus on learning for a few months. And I know that's easier kind of said than done, but if you use the agents correctly, they will framework the first 6 months of your journey for you. I can't do that because I don't even remember what my first 6 months were like, to be honest, because I learned that much over this whole period. Um, so yeah, it's always a
Yeah.
really difficult question to answer that. I feel.
It is, and I think for me, you've hit the nail on the head where so much of the information is gate kept, and I think one of the frustrating aspects for me was the fact that, especially when you go into X or other social media channels, it's everybody's running backtests that look amazing on paper, but they fall to shit when it's actually forward tested in a live environment. It's like, hang on a minute, this strategy isn't really all that profitable because it incurs a high level of curve fitting. But then I obviously the other thing that I actually want to touch upon, which has really impressed me as well with yourself, is that the other misconception I think is that you've got to come from a strong tech background or a coding background. You've got to be a Python whiz. Why don't you just elaborate your pathway or your segue into strategy creation? Because I think that was the one thing that really surprised me when you and I first spoke over a call last year. I was like, so have you coded these systems yourself? You're like, well, kind of, but not quite. It's not as difficult as you think. And I think that's one of the other misconceptions, that the pathway to starting systematic trading, even just developing a simple strategy like an EMA crossover, isn't as difficult as it appears to be. Or you've got to be some sort of Pine script wizard where you see people creating strategies on TradingView, which isn't my preferred way of creating strategies. I guess it's nice, quick and dirty, but really, I think if you're serious about evolving as a systematic trader, or even just using, I'm a big fan of S&B Capital, and they call it the bionic trader, where they're creating different systematic ways to help influence their real-time decision-making as discretionary traders. Is a really, really fascinating approach, because what you're doing basically is, when we use the word systematic, we're not purely talking about automated, but we're trying to systemize our decision-making process. Now, whether that's automated or not is the next level. But I think even from a systematic point of view, it really helps filter out the bullshit or the noise from your own game and helps you become more refined as a trader. So your decision-making process isn't fully emotionally led. There's a level of control involved in the way that you perform. But like I said, just want to go back to the point of how technical do you have to be? Because from what I've understood from yourself is that there are tools out there that remove that barrier to entry, where you don't really have to be a technical whiz or a genius programmer anymore.
Yeah, absolutely. There's hundreds of tools, right? And it kind of depends what assets you trade in, what markets you trade in. Are you futures, are you CFDs, are you crypto? And also what kind of trader do you want to be? But you're right. There's multiple tools that can be used, as a non-coder or non-developer. Some of which that I've used are the likes of FX Dreamer or Perfectus AI, which are what we call block builders. So it's predefined code that you effectively drag into a flowchart. Now, it sounds really easy, but it's easy if you understand trading. If you have no trading knowledge, then you're not going to understand at all what any of these blocks do. But effectively, you would say, for example, with the EMA crossover that you had, you would put a condition block where it says EMA 50 period crosses above EMA 200 period. That code is already predefined, right? It's pre-written by the software. Then you would put a buy now or sell now block or a sell limit block, whatever trade you're trying to execute. You would predefine all of the rules, stop loss X percentage or X ATR, TP, X percentage of the stop loss, all of this sort of stuff. And again, it spits out predefined code, which is great for prototyping strategies quickly and efficiently. If you have an idea for a system, if you have a hypothesis in your head, rather than sitting down, even as a developer, rather than sitting down for a week and building that strategy, you may as well put it together in a block builder within 20 minutes, right? Prove that the strategy works or that there's a positive expectancy behind the hypothesis before you actually go and spend, like hours, days, weeks on building and refining the strategy. The issue with these platforms is that the code is so full of fluff that it's very inefficient. It takes ages to run back tests. You're probably not the proprietary owner of the code. There's so many different, there's like a whole list of problems that come with it. So actually what I do, because initially that's what I did 100% of the time when I first started journeying into systematic trading. I don't use block builders anymore, and I'll explain why in a second. But I went through a period where I had all these strategies built, and I just got Claude and Codex to basically strip out all the fluff. I sat here for days going, okay, we need to extract the core logic from this code. Okay, so we're looking for XYZ logic. We're going to manage the trade like this, and we're going to execute like this. Okay, that's a core logic. Now let's strip the fluff. And I'll tell you why they put so much fluff in the code. It's a way of protecting their IP, right? So if you think, 5 years ago, 10 years ago, hell, even probably 2 years ago, if I give you a strategy file with 40,000 lines of code in, but only 100 lines of that code or even 500 lines of the 40,000 is actually to do with the strategy and is actually key logic that you need. For a human developer, it's not impossible for them to sit down and pick out those lines of code. It's, virtually impossible. With an AI agent, it's not so impossible anymore. It might not be accurate all of the time, but at least, with a good trader sat behind it, you will be able to recreate it somehow. But the reason I don't use these block builders anymore is mainly because I've now built my own encyclopedia of code. So as I build strategies, as I build kind of portfolio architecture, if it works, I save the code. I archive it into my what I call my strategy encyclopedia. And then as I build my next system moving forward, I then drag my own quote unquote blocks into that. Using Claude Code and Codex. I am not a programmer. I am not a developer. I can read code, but I can't write code very well. So Claude and Codex do pretty much 99% of my coding. I just change tiny little bits. There's other platforms like Strategy Quant as well, which uses a different approach. It uses something called data mining. So it will use a brute force strategy generation mechanics. So effectively, you would give it certain parameters. You would say, I want to build a strategy on euro dollar or on Bitcoin on the hourly time frame. I'm going to use these dates to build my sample. I want it to close at the end of every day or close at the end of every week. As many parameters as you can think of. And it will just brute force generate all of these systems. Okay, so 99% would be overfit and just completely curve fitted to noise. But sometimes you do generate a winning strategy. And there's different ways to curate the data mining so that you can kind of avoid overfitting a little bit. Not impossible, but you can do it to a degree.
And that's another really useful tool that I have. I think I paid about £1,000 for it. It's money well spent, although I haven't really used it too much in terms of on my live portfolio. But that's due to me not having the time over the past kind of year and a half to really deep dive that piece of software. But I know other really successful traders who have, and have really great multi-strat portfolios because of it. So yeah, the barrier really has gone. Um, you know, oh, I'm not a coder. Well, it doesn't really matter anymore. And you can go all in on AI and you can start from scratch. I still think block builders are a fantastic way to begin because it gets you thinking about the flow of the strategy. Okay, when this happens, that happens. When that happens, this happens, and so on and so forth. And then what you can do, like I say, is extract the core logic, build your own code, put it to one side, and leave it there for future use. So yeah, it's a really interesting kind of path and way to develop strategies because people don't realize that these things are available. And not that it's gate kept, I just don't think people are aware of it. And it's funny because I've gone through Twitter and YouTube in the past and I've seen claims from people, oh, I've got this strategy, 90% win rate, yeah, the initial balance or the ORB or whatever the flavor of the month is. And I've gone through and I've built and prototyped the strategy within 30 minutes, ran some tests and been like, yeah, they're talking out their arse. There's no edge there. The system over a 2, 5, 10, 50 year, kind of time range has no positive expectancy built within it. So it's a really efficient way of kind of proving or disproving a hypothesis.
Well, thank you for that. I think I'm going to put myself in maybe the audience shoes here because I already understand and have an appreciation for automated and systematic trading. I'm going to go back to maybe the time when I started and I'm going to fire two questions at you, just looking for a short answer. What's your thoughts on, hey, what if I just create one single strategy and I can run it on Bitcoin? Wouldn't that be great? That is an issue within itself, I guess, because I think if we recall back to our conversations, the importance of having a multi-strat portfolio, because I remember you telling me that when you create strategies, you test at the strategy level, but you also have to have multiple strategies simply because of the fact that the markets are forever changing. Markets change, conditions change, volatility. Certain strategies will perform really well, such as moving average in a trending environment will do very, very well. Whereas a moving average in a range bound environment on a given time frame is probably going to get chopped up. And so that's, I'd really like you to maybe touch upon, the trade-off between just having a single strategy and a multi-portfolio strategy, but then also the ways in which you need to test that. But secondly, the following question to that, and again, maybe it's a fully loaded question, is my mind has gone absolutely blank. I'm sat here as somebody who wants to get into systematic automated trading. I can't even think of a single strategy. Where do I even start? What do I need to understand? Where do I look for information? Do I now have to learn about all these various indicators such as the ATR, the RSI, the stock RSI, the moving averages? Do I need to understand how they work? Where can I even think about devising some strategy? Because I think you're running, nearly close to 25, 30 strategies now? Is that correct?
Yeah, I've actually stripped it back recently.
Interesting.
I've been on a hell of a purge recently, dude. I think I'm down to 16, but at the peak it was about 30 strategies. But it does fluctuate based on market volatility and strategy performance. But to answer your first question, so I want to be clear here. Like, it depends on you was asking between running a single strategy or running a multi-strat portfolio. Honestly, it depends on who you want to be as a trader. Do you want to be a professional asset manager who can scale to multi-million dollar AUM? Do you want to be that guy? If you do, you need to take it a little bit more serious than just building a strategy and hoping it works. That's where building a multi-strat portfolio comes in, which we can get into in a little bit. I know you said keep it short, but you can build diversification using different correlation metrics within the portfolio. So even if one strategy dies or decays, the other strategies kind of hold up the portfolio level. Think of it as not putting all your eggs in one basket. Um, Whereas if you're just someone who trades on the side and you're not really bothered, you don't want to be a trader full time, you just do it for a bit of fun, yeah, by all means, try and flip an account with a single strategy. I'm not saying it can't be done at all. I'm just saying that's not going to work in a professional at a professional level. You need to always be thinking of the next strategy that you're going to build or the next edge that you kind of want to bring to life. And to answer your second question, which was remind me of the second question again, bro.
God, I think it was to do
I,
with
I talk so much and so
yeah.
fast that I confuse myself.
The second part of the question, well, it's a bit of a fully loaded question. My mind's gone blank. I want to get into creating my own strategies. How do I even think about creating strategies? You know, I can't even imagine. I'm talking as if like from 3-4 years ago. Like, I'm so used to being a discretionary trader where I long demand and I sell supply zones. But from from what I've understood, there's so many more different ways in which you can extract value out of the market or develop edge, and it doesn't have to be as plain as simple as here's supply and here's demand. I'm going to take it from from A to B. You can just look for small inefficiencies or small opportunities in the market that compound over time. I think there's a misconception as well where quite often you see, especially in the crypto space, where you've got these copy trading bots and copy trading algorithms that claim to be probably making 60-70%, but then they blow up. They go on a good run, 2-3 months, 2-3 weeks if that, and then before you know it, they've taken a massive loss. Maybe just manage expectations slightly. What kind of returns would you deem satisfactory for somebody who, let's just say, both sides of the coin, somebody who wants to take this professionally, wants to scale their strategies? What's generally a good benchmark or performance metric to say, yeah, this is actually something that's worth working on it and refining over time? And then the flip side to that is, I want to create automated systematic systems just for myself. I don't really want to raise capital. I just want to run this on the side as passive income, but I do want to take it serious, and hopefully it becomes a full-time passion.
So I think there's two parts to that question that I'll tackle separately. To answer the second part, it's quite difficult to say there's a single benchmark because it does depend on the strategy that you're building, how frequent it trades, the asset it's trading. You obviously have the classic benchmarks like your profit factors, your Sharp, Sotino, Calmar, your Kaga, all those sorts of different metrics that you can look at a single strategy level and be like, okay, this fits, this is a good strategy. However, when you start building a multi-strat portfolio, or the book as I call it, you kind of have to turn away from those metrics. You need to look at them to understand if the strategy has edge and is good, or has a positive expectancy over time. However, you kind of then have to ask yourself, does this strategy earn a place in my book? If it's the exact same strategy as another one and the correlation is really high between strategy A and B, it doesn't earn a place. It doesn't matter how good the edge is, it doesn't earn a place in the book. So again, it's really difficult to put it down to one key factor. However, I would be looking, if I had one metric, I'd be looking at return to drawdown. I want to see that I can scale the risk on a strategy however high I like or however low I like. But what I want to see is that the reward for trading that system is worth the risk going into it. And of course, it being uncorrelated, or having a fairly low correlation with the other strategies that I trade. And then to answer your other question about generating different hypotheses, there's a few different ways you can do this, or a few different ways I do this at least. One, I lean a lot on my previous experience. So I tried a bunch of different trading styles, and over the years have learned and seen a bunch of different trading styles. I also spent a long time before I become a systematic trader actually deep diving into data and statistical based trading, which really helped me when moving into systematic trading. So there's different data points that you can begin mapping a strategy around. But one of my favorite, and to be honest, I think it's a little bit brilliant, and it's a very efficient way of generating hypotheses. Is I use Claude Cowork, and I have a scheduled task running every day. I have it turned off at the moment because I have too many strategies to go through. However, let me see. Let me see if I can open this and show. Bum, 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 bum. Where are we? Where are we? Where are we? Strategy 4. Is this it? Okay, so I set up. You can see this, right, Exo? Okay, cool. Oh, sorry. I thought the screen was showing. My apologies. So I set up a scheduled task, which for anybody who is unaware, it's something that you can build on Claude. I think Codex you can do the same as well, and there's probably other agents that will run it too. Every day at a certain time in the morning, my agent will scan different trusted sources across the internet and across archived books or archived research papers. It will only go to trusted sources that I've kind of pre-approved. For example, I don't want to be taking something from some new influencer on Twitter who's spouting about a strategy. However, I do have trusted accounts on X that it will scan, and it will look for somebody who's talking about a strategy. It will look for the entry and exit mechanisms. It will look for the trade logic, everything that builds that strategy. It will take it away and it will build me multiple different files around that strategy. So for example, if we just take one here, GBP USD 15 minutes. So this was built on the 24th of May this year. So it's a London opening range breakout. Okay, so we have a description. Let's see if this opens up. It's giving me a description of the strategy. So I'll move this across. And my PC's freaking out.
So just to reiterate, is this something that you've automated through Claude Cowork, where it just scans research papers? Is that correct? And it devises the strategies for you in what is essentially looks like a markdown file.
Exactly that, to a T. So I can open up this description. It will tell me exactly what the strategy does. I can then go to hypothesis, and it will give me the hypothesis of the strategy. Okay, 7 to 8 a.m. UTC, London in open range breakout, yada, yada, yada. I can then go into source, and it will give me the source of where it pulled that information from. So I can go through and I can look at all the citations, and I can understand, okay, who wrote this? Why did they write it? So Crable, 1990. So interesting. The opening range breakout is something that's kind of really popular now. However, this cite's 1990. Okay, and then we got Brett Steenbarger, Linda Raschke, and other practitioners who also have. So it's gone and done deep research on this. It's looked for not only the original citation, but who else has said yes, this works. I set it up so that it pre-validates the idea for me, because what I don't want to do is it provide me with a strategy that I have to go and then validate. I want somebody else to have been like, yeah, this works, basically. And then it comes in and it builds me the file. Let's wonder if I can open this in anti-gravity.
Just whilst you're opening this, why did it specifically choose GBP USD? Where did it know how to reference or point towards, hey, here's a strategy you could potentially apply in GBP USD? Was that picked up in the citation somewhere, or is it
the original citation?
Right, got you.
The original citation. So now I've opened MQL, which is the code that I work with, and you can see it's built me the full file. Now, all of these is my encyclopedia of code. All of these filters, all of this max risk monitor, it's what I have as kind of a secondary stop loss. So if for whatever reason my code breaks or the platform has an outage and my stop loss doesn't get filled, every tick, it monitors my risk. If my P&L goes above X amount, it will close the trade anyway. So it's kind of having a second stop loss. All of these different things. So that's my encyclopedia of code. It will then use all my predefined rules and, again, my encyclopedia of code to write my full file. So, and then I took it one step further and I got it to build a backtesting source with Python. And so let's see if this opens. So you can see, just looking at this, this isn't with real tick data. So you do get an accurate read of the strategy, but it's not exactly accurate in terms of with commissions and stuff like that. But for me, I would look at this and I'd be like, okay, in its raw state, this strategy is not, there's nothing that I want to do with it really. I would look through the semantics and see as to why it was just a downward spiral. However, that's not the point. The point is that by the time I get to my desk, I have 5 strategies pre-built, pre-backtested, cited from different authors, and I can look and I can go, oh, okay, well, I've got 5 hypotheses to trade. Yeah. Again, this curve might not be 100% accurate, right? It might not be. So I can go away and I can work on it. I mean, this looks super active. 2,000 trades. Is there any way that I can add some filters on here? Because there is periods of time where it has, winning periods. So is there any way that I can add filters without trying to overfit the strategy? If there is, I'll work on it. I'll be honest, 90% of the strategies that come through are like this. They're pointless to even try and waste time on it. However, the point is, it's another funnel for idea generation. And then once you build one idea, you might spark another idea. So you asked me why GBP USD? Well, why GU? Let's test it on euro dollar. Let's test it on dollar yen, Bitcoin, whatever asset it is. Let's test the same hypothesis, but instead of 7 to 8 a.m., let's test it on, 1 p.m. to 2 p.m. right before New York Open. There's so many different ways. You kind of have to just keep asking questions. Well, if that, why this? Can I do that? Okay, let's test this instead. You have to be super, super curious, and you really wanting to work on the next idea always. But I know I've kind of gone off on a bit of a tangent here, but I think it's really important because I'm really proud of this workflow because I just think it's so efficient. And whilst it does produce a lot of rubbish, it also produces 1 or 2 really great strategies, but it also gets you finding good authors, finding good research papers, which can spark the next idea and the next idea and the next idea. Even if I look at this and I just take away one bit of the code, whether it's the management of how it gets in or gets out of a trade, and so on and so forth. And there is other ways of building a hypothesis. I did write in my handbook on my website a few different ways that I do this or that you could do it. But again, go all in on AI. Yeah, that's all I got to say.
Yeah, agreed. I want to ask you some questions. So there's various ways in how one can actually run automated systems. At a high level, what types of strategies make up your portfolio? Are we talking about? So I'll give some examples. You generally can have strategies that are primarily trend following, mean reversion, statistical arbitrage, momentum, market making, directional, or even a blend of some of the ones that I've mentioned. Could you maybe talk about the main core tenets of your strategies? What is it that you're essentially from the gist from the conversation so far? I'm assuming it's primarily directional, mean reversion based, trend following, I guess. If I had to guess, were maybe 3 that you have. Am I right, or is that just a useless guess?
I like you said, I have a blend. So I have different approaches. I would say I probably have more breakout strategies than anything else. I love breakout strategies, and it was the one thing that I hated as a discretionary trader. But somebody once told me breakouts will change your life, and damn, were they right? Yeah, it's so true. Like the thing I love about breakouts, right, is I often talk about 2 different things. I'm gonna bring TradingView up just for a moment.
Yeah, so sure.
I often talk about different things. Ignore my lines on the chart as well. I I don't trade anymore. I invest. The lines are just for my reference. People will not differentiate between a constant and a non-constant variable, and those are terms that I've coined. Right, that's just what I call them. So I'll explain what they are. A constant variable is something that is replicable over time and doesn't change. So, for example, something of that is the time of day. We know without question tomorrow there is going to be an 8 a.m. We know that there's going to be a 12 p.m. We know that next week there's a Monday, Tuesday, Wednesday, Thursday, Friday. These variables do not change, but they are still variables, right? They have their own characteristics. Monday, you might get the incoming flows of the market. Friday, you get the outgoing flows. There's differences and nuances to each of these variables, but we can say ahead of time, we know that those variables are coming and we know the order that they're coming in, even down to NFP or something like NFP, which I find a really interesting variable because it's both. It's a non-constant and it's a constant variable. We know that the first Friday of every month, with making an exception for recent NFPs where they moved it, we know the first Friday of every month there's going to be the NFP print. Okay, so we know ahead of time that variable is coming. So we can build things around that because we're aware of it. However, the actual print or the reading of that NFP is a non-constant variable because it changes, right? And to go back to my original point, because I think it was important that I kind of explained what I mean by the non-constant and the constant variables, is breakouts are purely constant variables. They may be a different area on the chart, but if I'm looking at a breakout of the past 30 bars, it doesn't matter where we are on the chart. There is the past 30 bars, right? So it's something that you can go, okay, well, the market is always doing something, right? The market's either going up, down, or sideways, as people say. So it's a variable that is eventually going to be hit one way or the other, unless you have like some massive range and it just trades within. But I know at some point this is going to break out of the past 5 bars, 10 bars, 30 bars, 50 bars, 100 bars, right? Whereas if I start adding all these different complex mechanisms in, all these indicators, all these correlations with different assets, and I'm looking for what people coin an SMT, like how do you define an SMT, for example, which is when there's a divergence on one asset to another asset? Like, is that, do you know that's going to happen ahead of time? Probably not. So it's really difficult, not impossible, but it's really difficult to get some solid data on non-constant variables because they are so different. Another example I give on that is, for example, I used to talk about this a lot back in the day. So we're talking Bitcoin over here, right? I used to say when Bitcoin first hit 60K over here, the price point or the variable is the same as when Bitcoin broke back below 60K over here. It's the same price, right? The variable is the same. However, I know you'll remember this as well as me, XO. The euphoria over here when we first hit 60K and the demise that was felt within the crypto community over here was completely different. It was like, oh my God, we're at 60K, can't believe it. A couple of months later, oh my God, we broke 60K, I can't believe it. We're going to zero. Yet the variable was the same.
Yeah.
Right. So I
Yeah.
think it's a really interesting question to ask yourself, like, what am I actually building around? Is it something that can be seen ahead of time, or not seen ahead of time, but pre-planned for? Again,
Yeah.
my breakout ranges might be. So I could say the past 20 bars. Okay, cool. How often have these 20 bars been broken out of before? Guess what? You can run a simulation. You can backtest it. It's super easy to do. And that's why I love breakouts, because they're so simple. They're so easy. Not easy to make money, but easy to build a hypothesis on. And you can get them more complex. Like I do have some more complex breakout strategies, but they're phenomenal. I mean, even if you look at the S&P, right? Every time it breaks an all-time high, you get just a phenomenal trade. Like you have one here, you have one here, over here, you have one over here. Like, and quite often when you get this big V reversal and it breaks the all-time high, quite often you don't come back to it. So it's kind of like, and I mean, none of this is financial advice. I'm not saying it's never going to come back down to 7K, of course. But what I'm saying is, these things you can pre-plan ahead of time. It's a constant variable. Okay, when it breaks the all-time high, again over here, it's gone. Boom. I mean, well, comes back and tests it there, but it's something that you can build models around because
Yeah.
it's not too discretionary where, oh, if this happens, that happens, and ICT said this and that and the other.
Yeah,
Yeah,
absolutely.
I'll stop rambling now, bro. I'm
No,
sorry. I'm sorry.
no,
You've got me off on one.
no, it's great, man. It's great. I could keep you here all day if I could. I just want to go back to what you said. Backtesting, it's super easy. Where do I start? How do I begin with backtesting? Do I need to buy a certain backtesting software? Do I need to preload it with tick data for a given market? Do I have to pay for that data to get that market into the system? What if I'm getting data in by tick sizes or 1 minute bars? And where do I start with backtesting? Obviously, I know the answer to the question myself, but I'm asking on behalf of the audience. Like, if I want to start backtesting, what's the easiest way for me to come up with a backtesting strategy? Let's talk about that. I mean, what is enough data? What sample size of data do I use? Do I do on a 4-year look back? Do I look at the volatility regime? Do I measure it when there's been high volatile risk environments? Maybe that's Monte Carlo simulations that I use. How do I know I'm using the right metrics or the right sample size of data? And then not even that, well, I've got a cool strategy in my mind, but how do I know which market to apply it to? Is it the case where one strategy is only really applicable for one given market, or is a good strategy able to be applied to any given market that matches, let's just say, the volatility regime or the ATR of the asset of the underlying assets? So quite a lot of questions there, but you see where I'm coming from. Not only am I talking about backtesting, how can I very quickly get up and running with backtesting, but in terms of the strategy in itself, what if this strategy seems to be dog shit on, let's just say, Bitcoin, but on an FX pair it seems to be doing really well? How will I ever figure that out? And again, I guess it's just a case of digging through various data, and even the data itself. How do I preload the data? Because I understand getting historical data can be quite expensive, especially for TradFi markets.
You've asked a ton of great questions there. So I'm going to try and answer them all as best as I can. I mean, it completely depends on the market that you trade in. If you're trading futures, I'm not the best person to ask because, to be honest, I have traded futures in the past, but my book is built on CFDs. I know some people will turn their nose up at it, and fair enough, but until it stops working for me, I'm going to continue to do what works and what pays me. CFDs, also the data is free, so I'll bring up my terminal now. There's nothing on here that I think will give me away. So this is my live portfolio. This is what I have. You are seeing my book in action. I'm in one trade, which is dollar yen longs, fragmented into 3 orders. But this is MetaTrader 5. I'm sure most people will have seen the terminal before. Super basic, super easy to use. It is basic. It's not institutional grade to really, but you can build professional grade portfolios using MQL code for sure. I mean, I have.
Just to stop you there, are all your strategies basically living on MQL5 MetaTrader 5 with MQL now? Are you using any of the software, or are your strategies dispersed across different platforms, or is it all unified on one platform?
I am all on MQL, but if you'll let me, once I've explained this, I'll explain to you a really interesting architecture I've got, because I can expand on that in some really nice detail. So I can come into the strategy tester. So you would just go up here, view strategy tester, and it brings up the backtesting tool. You load your strategy. You then set your parameters. So if I go to every tick based on real ticks, it's going to use real spread, real commissions, real actual tick movements. If you use 1 minute open, high, low, close, it's not going to show you what happened within that bar. So sometimes you can get inaccurate data. It might show that you've got a really profitable strategy, but you kept getting stopped out within the bar and it didn't register it. So I always run my back tests on real ticks. Now, when you're testing on real ticks, it takes an incredible amount of memory. So, and I'm talking like storage memory, not RAM. So you need a decent hard drive. If you're using 1 minute bars, you're probably looking, I don't know, 20, 50 megabytes for 10 years worth of data. If you're doing it on real ticks, you're probably talking 20 gigabytes. So it's an incredibly large file, but without that, you're basically not getting accurate information. I always then give myself a bit of a delay. What you want to do when you're backtesting is give yourself kind of the worst possible execution that you can within reason. There's no point in giving yourself the best fills, the best spread, the best commissions, the best latency. You want what's going to be happening in live markets so that you can say, I know what the worst case scenario is when I'm executing live. So I always put a bit of a delay, and then I use accurate leverage. So my account is run on 30 to 1. So I use 33 to 1 on here with 100K balance. Cool. I then go into my strategy file. I input all of the parameters that I have from my strategy. So this is something that I'm currently building now, which is what I'll expand on in a moment because I think it's super, super interesting. And then I can go into the backtest, for example, and it will run the strategy for me. So this will run, I won't do it now because it'll eat up a load of my PC power and I don't want to lag out of the stream. But B, this will take about an hour to run this test because it's my full portfolio. Now, to answer your second question, you asked about sample periods. Now, this is where a lot of people get tripped up. They enter systematic trading, and this is me talking from experience, and they pick a time period and they go, I'm going to build the strategy and test it on this time period, 10 years worth of data. At the end of it, they go, oh, fantastic. This strategy is great. I've got 10 years worth of data on this. Great. I'm going to go live. And then inevitably what happens is they set the strategy to go live and it starts to fall off a cliff. What they've done is they've overfitted the strategy. So you'll hear the term overfitting quite a lot when you venture into this world. And effectively what that means is you have built your strategy around what you already know has happened. Okay. So I can look at this and I can go, okay, well, we have a period of time here where, nothing really happens. We're underwater in a stagnation phase for a period of time. Okay. Well, I'll tell you what, I'm just gonna find a way to get rid of all the losing trades within this time period. Oh, they all lost on Wednesdays. We'll turn Wednesdays off. Okay, turn Wednesdays off. The curve looks better. Okay, they all lost at 9 o'clock on a night. We'll turn 9 o'clock off. Curve looks better. Maybe if we add this filter, curve looks better, curve looks better, curve looks better, until you get this perfect equity curve. And then you go, okay, well, I'm happy to set this live. But when you're moving forward, you don't know that those patterns are going to continue to happen. So all you've done is you've curated this system that is so overfit to pass noise. And yes, it might work for a period of time. It might do, but odds are it will fall off. So the key is to look for a stable curve, not a perfect curve. The way that I do that is I have, and there's no right or wrong way to do this. So please don't take my word as gospel, play around with it. Feel free to be adventurous and to try your own periods and to try your own methods, because I think that's super important. But I use 2 years to sample my hypothesis. I use 2018 and 2019. Those are my 2 years. The reason I use those 2 years is because historically, those are the toughest years I found for pretty much every single strategy I've ever built. Obviously, there's a few exceptions in there. I'm not saying it's the same for all strategies, but generally, that's what I find. I build a hypothesis and I test it on those 2 years. Then I will optimize the strategy. I will try and make it better. I will try and fine tune the stop. I'll fine tune the target. I'll add filters in. I'll take filters away. And I will try to get the strategy as robust as possible within that period. Once I have a working strategy that I'm happy with and I have that in sample period, which is what we've just discussed, those 2 years, I then move on to my out of sample periods. The out of sample periods is where you then test that hypothesis on data that you haven't seen. Again, so we know what happened in 2018 and 2019 because we ran the test, we tweaked it, we ran the test again, we tweaked it again, we ran the test again, and so on and so forth. Whereas from 2020 to 2026, we don't know what happens in that time. Like we know obviously in our head, but we don't know how the strategy would have performed. So I then run the strategies on that time period. If it passes that test and it still looks good and the metrics don't fall off, then I'll run it onto my second out sample period, which I run 2010 to 2018. So before my in sample period. And that way I catch different market regimes. I catch different interest rates on different currencies. I catch bull markets, bear markets. I catch gold going vertical, the S&P going vertical. You catch Euro Swissy losing the floor. You catch Brexit, Trump being inaugurated. All of these different variables that you want within your strategies to kind of see if they survive those periods of time. Again, there's no rule to you have to do this or you have to do that. That's what I do, and it's worked well for me. But feel free to kind of play around with those periods and find kind of what works for you. But your out of sample periods isn't to it's not to make you feel good. It's to try and kill your strategy. You want to catch a broken strategy as early as possible. And so that's the way I split mine. And again, it's not a right or wrong, but that's how I do mine. And generally, I find I build pretty robust systems.
I think there's an overlap between being a software developer and creating strategies. A good software developer will write good level of unit tests, integration tests, end-to-end tests, because what they're trying to do is essentially break the system or find its weak points. And I guess that could also be applied to anybody who's good at creating trading strategies. Would you agree there, Kieran? It's that you've got to have that mindset, right? Okay, I've got this strategy. How can I absolutely break the shit out of this to make it fail until I can no longer seem to make it fail? And then when it does fail, it's in a real live environment. I didn't think of that. Now I need to go ahead and fine tune that. Have you come across that yourself before, where you've tried to really break down the strategy as much as you can, and then you've got into a live environment, and for whatever reason, let's just say 1 week out of many, it's had a fairly significant down day. Would you then halt the strategy at that point until you've rectified a blind spot? And secondly, the additional question that I wanted to ask was, well, how long do you keep a strategy in backtest and then in forward test before you actually go ahead and deploy that strategy? What do you need to see from the strategy to give you that confidence, right, this is now ready to go into a live environment? So again, a couple of more questions there for you to kind of talk your way through your process.
Yeah, so it's a really great question, actually. The backtest can be done in 30 minutes, an hour, a couple of hours. And as long as it ticks all the boxes from what you want to see and you've got all your security mechanics built in, I then just put it live onto a secondary book that I have. So it doesn't go live into my main portfolio. It goes live on a second account, which is my testing ground. And then I usually run it for a whole quarter, so 3 months, just so I can get an idea of, I'm not looking for it to, win every trade in that period, but I want to know that it's robust and secure. I want to know that the stop works, target works, it executes flawlessly, all of the security is taken care of. And then I will move it to the live book if there's a gap in my book for it. Again, if I'm heavy on gold, I'm not just going to add another gold strategy because I have it. I will keep it reserved until I need it. But generally, I forward test or live test for 3 months before I put anything on my live book. Again, that's just a period of time that I'm comfortable with. There's kind of no right or wrong to doing that. I just like to know, and again, from past experience, I've been bitten in the arse so many times. And luckily, I've survived every time I've been bitten. More so from, like you say, blind spots in my strategies as opposed to, the strategy didn't work. So I got burnt on silver because I didn't have a spread filter built into my strategies. As soon as I got burnt on silver, I built a spread filter and put it in all of my strategies. I got burnt on gold. because I had miscalculated how it worked, the stop size. So when it executed the first trade, and this was on my testing book, so luckily it didn't hit my actual account. It miscalculated the stop size, and because it miscalculated it, it didn't place a stop. So that's a fatal flaw in that strategy. And I remember getting to my desk that morning. I opened up my test account and I was like, "Whoa, what's gone on here?" Straight away, I knew something was wrong because the P&L was like 10 times larger than it should have been, and to the downside, right? So I was offside on that position. So I closed it, looking at I looked, there was no stop. I closed the position and went back through all my reports. Every trade on my backtest had a stop loss there. So I was super confused as to why it hadn't had it. I read through the journal. So you have journals on MetaTrader, which tells you what was happening in certain times. So I went through to make sure that I understand why it had happened before I start the diagnosis. I had got the diagnosis before I started the recovery. Hence why I mentioned on my inputs, I have, where is it now? The max risk filter. These are all the variables within my strategy. Yeah, it wasn't on this, was it? It was on the other one. Sorry, my bad. I have a max risk filter built into my strategies so that I can predefine. Let's say I'm risking $50 on a trade. I can stick that on as a max risk filter as well. So even if I don't have a stop, or even if my stop doesn't get filled or gets gapped over, or whatever the case may be, every tick of movement, my strategy is looking at my P&L so that I don't have to. And if my P&L goes above $50 in the negative, let's say, because I've set that max risk filter, it will just close the trade. So I'm not holding on to any stale positions. But again, the only reason I have that filter or that mechanism is because I got burnt and I learned from it, rather than just going, oh, well, bad trade, move on. I go, well, how can I make sure that that doesn't happen again? How can we stop that from happening a second time? Because I like sleep. I don't want to be waking up at 3 a.m. thinking, "Oh God, am I long gold again?" and it's fell through the floor, which is super important. And I'm gonna have to apologize, XO. I can't remember the other parts of the question because I went off on such a tangent there. I think I did answer. I think I did answer all aspects, or the majority of the question, because it was a lot about forward testing and when you'd move it to a live book and stuff like that. Um, mhm. Absolutely. Before I get into that, what I'm going to do, because it won't make sense until I do this, I'm going to get trusty old paint up. And so just let me know if you can see paint. Um, so I've built XAQP is my portfolio name. Okay. So I built the XAQP brain, which is, for those who know, my MQL5 file. That is what executes my trades. Okay.
Sorry, Kieran. I'm just going to stop you there. I just realized I was muted. Basically, sorry, folks, I was muted. But basically, what I was asking Kieran was, on his MetaTrader screen, he's got a bunch of variables: portfolio variable, execution variables, order splitting variables. And what I've asked him is to just go over kind of the core structure of his strategies. So how he flows from creation to key variables that he really pays attention to, and how it all fits together. Sorry, go ahead, Kieran.
That's cool. So the XAQP brain is what you're seeing there. It's kind of my master code. It is what executes. And then I split the following MQH files, which is again in MQL5 language, into two different components: strategies, so strats, and skills. Oh, misspelled skills. That's embarrassing. So strats and skills. Now the skills are what you're seeing here. So portfolio risk, order splitting. So what we do, order split, for example. I apologize for my awful mouse typing. And strategies 1, 2, 3, 4, and so on and so forth. Now what happens is when strategy 1 fires a trade, that trade is sent over to the skill, okay, using the brain. The skill then goes, okay, well, we know that we need to split the orders, and the reason that we split the orders is for capacity, which I can get into if you want me to later on, but it's super important. When you're scaling as a professional trader, capacity is it is your product. It's what you're selling to investors. So I split my orders into 3 trades. Okay, so 1, 2, 3. Hence what you see here. 1, 2, 3. Okay, what other skills do we need? So we need the max risk. Okay, cool. So this max risk skill is going to be monitoring all of these trades. So these trades are protected not only by the configurations that we have in the strategy file, but also by the brain. So it's really important because this is quite high level stuff, right? And you don't have to be doing this on MetaTrader. You can do it on using Python or whatever language that you use, Power, to build your strategies and to run your book. But I think it's super important that from day one, anybody who's going to start doing this, you use it with this framework in mind. You build the brain, and the brain splits the skills and the strategies. The skills oversee the strategies, not the other way around. So, for example, a really important one is clustering or correlation. So, what I mean by that is if I've got 3 strategies on gold, for example, and 2 of those strategies get long, and then my 3rd strategy also wants to get long, we can set a skill to set our max exposure. Usually the strategies fire separately and they don't correlate highly, meaning they execute at the same time. But if they do, we want to block those entries. Whereas strategy 3 can't always see strategy 2's trades if they're running separately. Whereas when we have the brain overseeing this, we can go, okay, we don't want to be too exposed to that asset, or at least in the same direction. So it's just a really efficient way of running your book. And I think everybody should it's a bit of an awkward way to look at it because I've used Paint, but split your portfolio architecture into strategies and skills, and that builds your brain. Effectively, you want to be asking, how do I not have to make a decision? And that's by predefining all your criteria. So even on a bad day, it's not too bad.
Yeah.
So he was asking all of these different metrics. So for example,
just the folder level, really. What the folder level? So you got portfolio risk, and if you just pick out 1 or 2 examples, or 1 or 2 sub files within each folder. So at high level, you've got portfolio risk. That's, I guess, monitoring your entirety of your portfolio and all the strategies. Is that correct? So it's kind of like an overarching view of everything that's running in the system.
Exactly. So there's 2 levels to risk management for your book. You have your sub-strategy level or individual strategy, where you go, we're risking X amount on this trade to make X amount, so and so on and so forth. But then we also have the portfolio risk management. Okay, so what's our max loss on the day? Do we want to enable that? So you can see true, $2,000. That's just an example, but we can set it to $500 if we want to. What that will do is it will block any further trades throughout the day.
And is that reset by UTC hours? How do you set the times on for that? Let's just say I'm based in Asia and I trade Asian markets. All right, I see there's a session reset time. Cool.
Yeah, so that's my broker time. So that's actually 9:59 because it's in the UK. I'm 2 hours behind the broker. So that will be just before market rollover. So when the market rolls over, it's classed as a new day, right? And then my portfolio can execute trades again.
But this is the core of the brain. This is where it goes. The brain will not let the portfolio blow up. The single strategies have no idea what the other strategies are doing. Even if they're in the same positions, they don't understand why we're exposed in a specific direction. The portfolio risk management is there to make sure that your bad days don't end your career. Then we have execution defaults. So this is just basically a spread and slippage filter. It won't execute. This is in points. So if 30 points would be 3 pips, 200 points, 20 pips, etc., etc. That basically blocks out any trade. So if spread gets blown out because of rollover or because of news, and my strategy tries to fire, but dollar yen is above 3 pips on the spread, it will block that trade and won't enter it.
Is that your
Really,
spread
really
filter?
key.
That's your spread
Yeah.
filter, isn't it? Yeah. Yeah.
Really, really key. I got burnt on a dollar yen trade where spread blew out to 45 pips, and I got filled 45 pips above market. Luckily, by the time I closed the trade, I was actually in a little bit of profit. But as soon as I got into profit, I closed that trade because I was actually up 40 pips, but my P&L was break even, so I closed that position. Same with slippage. If I'm going to get slipped too much because price is too volatile and the fill price is moving too quickly, it will block the trade.
Yeah.
Portfolio order splitting. Again, this is for the scalability of the portfolio. If I'm hitting the order book with one go, bearing in mind my AUM right now is about $4 million. So it doesn't sound like a lot of money, but when you're hitting a broker, full clip with 4 mil, back in the balance with leverage, you're going to have a little bit of market impact. Nothing crazy, but you will have a bit of market impact. Splitting your orders, fragmenting your orders, and putting a slight delay between each one. So you can see here, my overall rules is we split the trades 3 times and we split them by 3 seconds. So position 1 fires, 3-second delay, position 2 fires, 3-second delay, position 3 fires. That has all its own risk management built in. For example, all the stop losses will be the same because you don't want to delay getting out on the stop. However, the TP will also be delayed. So you can see the target on this trade, only one position has it, the other 2 doesn't. So if that trade hits target, again, it will fire, 3-second delay, trade 2 will close, 3-second delay, trade 3 will close. It reduces your market impact massively. And actually, again, people don't understand the importance of this. My used capacity, meaning how much impact I was getting, was 47% at one point because I wasn't fragmenting my orders. So my hypothetical AUM cap, or my capacity at that point, was about $3.5 million at the time, meaning I couldn't take on more than $3.5 million in AUM. Otherwise, I would wipe the book clean and I would get really bad fills.
Yeah.
I started splitting my orders. Within a month, my capacity was like over 100 million. So in such a short space of time, when I recalculated all the metrics, and I do that using Darwinex, my capacity had absolutely skyrocketed. Don't leave it too late to worry about your capacity, because if you find success, you need to be ready to scale. And then there's more. There's like my brain. So this is my regime filter and how it affects my different strategies. So for example, if the ADX is widened, if ATR is widened above average, if the VIX is widened above average, if interest rates are XYZ, all of these different factors feed into my portfolio brain and go, okay, because of that, we're going to scale in an extra 20% size on a breakout trade, but we're actually going to scale back on a mean reversion play because actually the regime isn't conducive to that type of strategy. This is a relatively new thing that I built and I'm really excited to deploy it. But again, it will go on my second portfolio, my test account first, just to make sure the mechanics work really well. But effectively what I'm looking to do here is not just run 20 strategies in isolation, really, really dial in on where do these strategies perform well and why. And if I can scale into those or scale out of those, based on the regime, that's what's going to take me from the level I'm at now to the kind of next level, where I'm a little bit more institutional grade, which I'm really, really excited about. And then you can see after that, it just gets into my strategies. So my first strategy is a mean reversion system that I built with the RSI. I run it on 3 different assets. And I've got all the settings. Actually, that's probably given away some of my edge. So I think we'll scroll away from that now. Luckily, it's an infrequent strategy, but it's a beautiful strategy. In fact, actually, there's a key thing that you won't see on here, so it doesn't really matter, to be honest.
Yeah.
But that's now onto my strategy detail. So, what am I executing? We understand how it's going to be managed. We understand the brain behind the operation, but actually, what are we trading and how? That's where you get into the juicy bits. And so that's kind of how I'm architecting all of this now. And it's been a steep learning curve for me, but I'm still learning. I'm still loving the process, which is really, really important. And I think what I'm going to do, Exo, is I'm just going to bring up my actual curve. So for those of you who've made it this far in the stream, I mean, thank you for listening to me so far. But this is my curve since April 2025. So total return as of today, or as of right now, is 44% with a max drawdown of 5.83%. I currently manage 1.6 mil on Darwinex, and then another 1.5 or just over 1.5 million for boutique funds outside of Darwinex as well.
Yeah.
This is my credibility, so to say. This is I'm not just some guy telling you what to do. This is what I do day in, day out. And I think it's really important because there's so much crap out there, especially when you get into really trying to grow and develop as a trader and get to that professional level. There's not a lot of people out there living it, breathing it, documenting it. So really look at who you're following in this game and the advice that they're giving, because half the time they're not running a real book. That's the one thing that I will say is I run a real book, and I am speaking from experience. So yeah, sorry to
Yeah.
throw
No,
that in there.
absolutely.
So, but I don't want anyone thinking, oh yeah, this
No,
guy's just
for
talking.
sure. No, it's no. For me, you're about very, very legit as they come, in all honesty. And your max drawdown is phenomenal there. 5.5%, nearly 6%, which is excellent. I think one of the key things that investors look for is how good is a strategy or a strategy manager in terms of managing risk to the downside, I guess. Let's step away from the technicalities of, building strategies. Why don't you talk us through more of your lifestyle? I think what's really appealing to me, again, we're of a similar age, you and I. We've got responsibilities, and I think this is probably relatable for the audience. Why don't you talk us through some of the difficulties that you had with discretionary trading? Because I think it would resonate very well with all of us. And what's changed since you've gone down this path of automated systematic trading, and what has it allowed you to do in your time, things that you want to work on? Obviously, you're probably spending a lot of time on this, but more from a psychological perspective, the pressures of trading, the stresses of trading. What's been the top 3 changes, do you feel, since you've gone down this path as somebody who's involved in financial markets, I should say?
Okay, great question. I'm going to preface that with, I don't think systematic trading is for everybody, right? I think if you're a really good discretionary trader, then you don't have to make that switch. You can keep doing what you're doing, and if you enjoy it, fantastic. However, for me, I know you guys can't see it, but my office is in my bedroom, right? And I have 2 young children, and my commute is 2 flights of stairs. If I had a bad day and it was all on my decision making, 2 flights of stairs isn't enough to wipe away that bad mood, or to wipe away the feeling that you have when you've made a bad decision, you've took a trade that perhaps you shouldn't have done, or you've mismanaged a trade, closed it early and it ran, whatever the case may be. I was getting downstairs, and again, it takes me 10 seconds, and I was still in a foul mood, right? I haven't shook off the day, or the work day at least. And I wouldn't say I was creating a negative atmosphere for my family, but I wasn't creating a positive one. And that really, really hit me because I'd go downstairs and my kids would be like, "Daddy, come play. Daddy, do this." And I'd be like, "No, I've had a hard day. I don't want to do that. I don't want to do anything." And I caught myself very, very quickly when I started to fall down that trap. Um, Whereas now, if I have a bad day, I understand that it's predefined architecture that I need to solve, or one of my strategies is just going through the inevitable stagnation or drawdown period that I know that it has. Um, which moves me on to point number two, which is you can understand your data way ahead of time. It's so difficult to backtest a long period of time as a discretionary trader, and especially to do it without bias. Whereas with algorithms, you can test them, you can batch them into different sample periods. You can do walk forward analysis, so you can optimize walking forward on data it's never seen, and it's so much easier to do. You don't have to get trading view open and go on the bar replay and play through. You just don't have to do any of that. So you have um, an incredibly high confidence in your strategies because you have so much data on them, which is just, again, it's not impossible to do with a discretionary strategy. Unless you spend an ungodly amount of hours backtesting and backtesting and backtesting. And even then, I am a strong believer in backtesting, but I think you still get an element of bias in there. You can't remove human bias. Um, and then the third thing for me, which has really opened up my eyes, is to understand capacity. So again, I probably sound like a broken record talking about capacity, but I never thought about scaling when I was a discretionary trader. Of course, I thought about it. I was always under the illusion of, I'll just get more capital, I'll do that, yada yada yada. I never experienced what happens when you hit a bottleneck when you're trying to scale. And I did when I was systematic. Again, it was back in earlier this year. I think it was in February. And when I hit that bottleneck, I was able to diagnose it. I was able to implement something, and within a month, I had it fixed. As a discretionary trader, it's so difficult to go through, audit your process, and find ways to improve when it comes to things like capacity, because you have to rejig some of your strategy to a degree, and that's hard to do when you've spent years crafting a bias, crafting a process, and going, this is my edge, this is the way I trade, and then you go, oh well, that doesn't work because of capacity. You can only manage 200K. Okay, well, something needs to change. Oh, but I can't do that because I'm married to this strategy. It's my whole life. And you don't have that as a systematic trader. I could happily remove one of my strategies and wouldn't bat an eyelid. You don't have that emotional attachment to the way you trade, which is very clear now that I am a systematic trader, because everybody always asks me, so I'm thinking about automating my trading strategy. I've got this really discretionary process, and I'm like, yeah, bin it. It's not going to work. Just keep it simple. Just trade some breakouts. like
Yeah, yeah,
your
yeah,
discretionary system works because it is a discretionary strategy.
absolutely.
There's no point in building it into a system. If you're going to build a multi-strat portfolio, then drop your strategy at the door. You don't need it. So yeah, there's
Yeah,
my three things, dude.
yeah, brilliant, brilliant. Do you ever see yourself still dabbling from a discretionary perspective, or is it more of an investment perspective? Let's talk about
Yeah,
Bitcoin. Are you trading Bitcoin at any point, or are you just basically buying and sitting on it?
I'm just buying, dude. Bitcoin to me now is like, it's a stupidly good bet. Again, no financial advice. Like, I have skin in the game, but I'm not telling you to get skin in the game. But to me, like, even if this goes to zero, I mean, it is what it is. It's not going to go to zero. Let's face it. It's too big of an asset to go truly to zero, in my opinion. Yes, I would like 50K. I would even love 30K, but I just don't see that happening, really. So like, if I spend a year accumulating here and it dies and goes to zero, guess what? I haven't invested enough to kill me. But if I invest and it goes to 100K, phenomenal. I've made a great return. you know,
Yeah, yeah.
60%, 70%. If it goes to all-time highs, even more. So I am just every week, and this is my rule. Every week on a Monday morning, I buy metals, indices, and crypto. Period. Like just a small amount, week in, week out, and I do that every Monday religiously, regardless of price.
All right, regardless of price, regardless of regime, it's just
Regardless of price. Yeah, I mean, don't get me wrong. I didn't do it when Bitcoin was at 120K. I waited until it was below. I started accumulating over here when it was 60 something. And that's when I started buying it weekly again. Because I've been out of Bitcoin for a couple of years, to be honest with you. I rode it all the way from 2017, 2018, and mainly altcoins, but I still had some Bitcoin. But yeah, I just DCA every single week, just little bits that I don't even notice leaves my bank account. And then when I get a performance fee from my trading, because I have my job at DarwinX that pays my bills and then some, I just go with all of my fees. I pay the tax man, and then I put it to the side, either in cash, into my metals portfolio, into my indices portfolio, crypto, or other investments that I have.
I think what really one thing I should have touched upon is the fact that you've built out your automated strategies whilst having a full-time job. Which is pretty impressive, because obviously this does take a lot of time and dedication, as does anything. You know, the amount of time that you put into it really does make a big difference. I just wonder, just whilst we're here, any questions from the audience? Is there any questions you'd like me to fire off to Kieran before we wrap up the stream in the next 5-10 minutes? But it's been a great insight, Kieran, so far into everything that you've discussed today. Really has.
I think it's difficult to get it all into one stream because like I say, I've been doing this for over a year and a half now, and I still feel like I'm learning constantly, and again, going back to my point earlier, you have to be incredibly curious, and you have to question everything. Why does this happen? How does it happen? Is there a more efficient way to do it? Is there a better way to do it? I like to say efficiency is speed times quality. You don't sacrifice one or the other for each other. So I wouldn't sacrifice quality to get more speed. Or to do things faster. But equally, I wouldn't sacrifice speed to get higher quality stuff. It has to be a balance. You have to try and increase speed whilst increasing quality, which is why I love AI, right? And so the kind of key thing that I think people should take away is that efficiency is such an underrated. I use that term every day. Like, try and be more efficient. I use it with my team at DarwinX. I manage a couple of guys at DarwinX, and I always say to them, "Is there a more efficient way to do this?" And they're like, "What do you mean, faster?" I'm like, "No, efficient. A faster way of getting the same high quality result." It applies to everything in life, which is why I think AI is so great. Again,
of course, it's such a massive leverage booster to productivity. It's like I was saying earlier on stream and on the timeline. I think I've been in swing positions for the best part of 5-6 weeks. I haven't even been trading a great deal, but I'm just mentally exhausted from constantly having to fucking check my positions and making sure that I haven't given too much back to the market. Constantly making sure that my algorithm is dynamically adjusting stops how I'd like it to be. Have you got to a point where you barely look at your strategies on your P&L? It's just, that you've got faith in your system. Where I remember listening to Robert Carver, where he just goes about his day normally. He's got his systems running. They've managed risk really exceptionally well, and he doesn't really give too much. He's not fixated to the screen. Oh shit, how many strategies are running? How much am I up? How much am I down? Because he knows over a longer period of time that his systems perform well. Have you got to that stage yet yourself, or are you still having a peek at your, at which strategies fired, what positions you're in, what's the current P&L? do you get my point?
24/7, I know what trades I'm in. It's
Brilliant.
I wouldn't say it's bad. but I manage my portfolio very tightly.
Yeah, yeah,
I guess it's the way of, I trade a lot of, or relative to, 4 million might not sound a lot to some people, but to some people it's a huge amount, myself included. And so I treat it with the respect that it deserves, in my opinion. I want to know what I'm in, when I'm in it, how much I've got at risk, what my P&L is. I want to know, not out of like, oh my God, I need to babysit this, but I want to know what's going on. Um, and that's just because I feel a weight of responsibility for the people who've trusted me to trade on behalf of them. And so because of that and that reason alone, I can't take my eyes off
yeah,
of
yeah.
I mean, I can, don't get me wrong. I can go, I'm going to America in a few weeks. I won't be checking my positions a lot while I'm over there. So I can walk away and kind of leave it to its own devices. But I just like to stay in the loop and yeah,
I
I have it
guess
open pretty much all day.
I guess another way of looking at it is you're just monitoring your systems. And talking about monitoring systems, do you have an alert system that fires off when the system enters a trade or when it closes a trade? Do you get an alert notification or an alert for that?
Yeah, my phone pings off. Which it's kind of annoying because it pings off with all the order splitting. So
Right.
sometimes sometimes my phone will go ding 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 ding
Yeah,
ding.
yeah.
Uh, but yeah, that's built into MetaTrader. They have like a notifications feature, so I just turn it on all the time. Again, I'm not one of these operators who builds and forgets about it. I have, AUM that I feel responsibility for, so I want to know when things are moving and when things are happening.
Yeah.
Um, I just like being in the loop.
So what's the next logical progression for you as a somebody who creates automated systems? What's the next 6 months look like for you? What are you currently working on? Where are you trying to get to? More from not let's not say LP or assets under management. Obviously, that's inevitable. You'd like to grow that over time, but you yourself, in terms of your own goals as a systematic trader, what's on the horizon for you for the next 6 months?
I am working on the architecture a little bit still. So the brain I'm working on at the moment. Strategies wise, I don't feel the need to build any more strategies. I still am in the meantime, but I'm not spending a lot of time doing that. I'm trying to get my architecture to a place where I can translate it into any different language and trade on any different platform. But first, I need to perfect it in MQL. It's pretty much there. It's just a few final things that I need to add. Once I've got that, I'll translate it and then I'll start, dabbling with futures and stuff and diversifying my accounts over there as well.
Yeah.
My main goal in ideally this year, but probably next year is to hit 10 million AUM. When I hit 10 million, that's when I'm going to take some time away and I'm going to be like, right, okay, now I need to spend a couple of months thinking what's the end goal here? Do I look at creating my own fund? Do I look at taking this to Goldman Sachs?
Yeah.
I have
Yeah.
I have a really great network of people through my work at Darwin X. I've met some amazing people. And I would like to lean on that network when I feel like I'm in a position to do so. So I have some deals in the background at the moment for AUM currently being negotiated on my behalf by an allocator. I would like to say by the end of this year I could be at 10 million, but I'm not rushing that, right? I'm not, I'm so unbothered about when that happens, but that is a goal of mine. I feel like 10 million is a nice number to kind of say that you manage, right? It's a decent amount of capital. So when I hit 10 million, it will be okay. The next goal is 100 million, which is institutional level. So what do I need to do there? I can't do it while sat in my bedroom and being a one-man band. I'll have to look at recruitment. I'll have to look at an office space. I'll have to look at new technology. All of these different things that go into okay, changing from a 10 mil book to a 100 mil book. Like again, things like capacity. I need to fragment my orders a lot more. I need to trade futures instead of CFDs, or get institutional pricing on my book. So that will be the next phase. But honestly, right now, I don't know how that will look, other than kind of the bird's eye view, looking down at it, going, yeah, I'm going to be. Looking at new tech and all that sort of stuff. But that will be my goal. 10 mil, then it's the road to 100.
Yeah, fantastic. Question from the audience: what was or is the biggest bottleneck you've encountered when you develop these strategies in terms of the tooling and in terms of the toolings that are, in terms of the tools that are available? You know, how did you know where to start? How do you know which tools to pick out? How much time did you actually spend researching various platforms? Because I remember you first having started out on FX Streamer, didn't you? Before you then transitioned into shifting over to MQL, I guess, MetaTrader 5. You know, it's like, just imagine yourself starting out with not really much domain knowledge, I should say. I guess you've got it on your website. So maybe that's a good segue, because, you know, for people to be pointed towards the right direction. Look, where can I start? How do I start? I think that's a great segue actually onto your free. You've got a lot of free content out there. So in fact, let's just go over that now, because you've got your own website. Tell us more about the website. What kind of inspired you, you know, to come up with a website, and what is the purpose of the website here?
Yeah, so that question is exactly the reason, or one of the examples as to why I put my website together. So I'll quickly answer the question, because it's a super easy one. The bottleneck wasn't the tool or the tools that I used. You're right, I used FX Streamer, which is a block builder to begin with. The bottleneck was the lack of knowledge I had on how to build using that tool. So nobody told me I needed to filter for the spread. Nobody told me that I should have a backup stop filter. Nobody told me any of these things. So I had to learn I mean, I had a close friend who was doing it, who helped guide me occasionally. You know, but nobody told me that there was certain criteria that I had to do. And that was the biggest bottleneck, because it takes time. You know, you build strategies, you run them for 6 months even at a time, and you don't realize that there's a blind spot until you get bitten by it. So the biggest bottleneck wasn't the tech or the stack that I had. It was purely the knowledge or lack thereof to be able to use the tech correctly. Which, like Exo says, it's a nice segue into this. So it's kieranduff.com is my website. So there's a bit of information about my portfolio on here, and then I'll go on to my articles in a second. But one of the things that I released recently, I think it was a couple of weeks ago now, is my handbook. And the idea of this actually came after a conversation Exo and I had a while back, where he was trying to challenge me to think like a beginner and answer these sorts of questions. You know, if I'm starting out today, where do I go? And honestly, I don't think there's many places, unless you're willing to dump $5,000 on a course.
Yeah, it's ridiculous.
Don't get me wrong. Yeah, I mean, I know a few guys who sell courses for like 4 or 5 grand, and they are phenomenal traders. But for me, I would never charge $5,000 for a course, right? I just don't like it. But I put together this handbook, which is 24 chapters, answering every single beginner question you have. You know, from the basics, what systematic trading is, why go systematic, all of these sorts of things. I talk about MT5 a lot purely because it's what I use. You know, but there's no right or wrong. You can use you know, whatever platform that you want, or that you know, want to build this sort of thing. I talk about using AI agents, scouting for edges. So some of the thing that we spoke about earlier, where do your ideas come from? Own trading observations, what I said, existing research, strategy decomposition. So taking the good and bad of your strategies that you've already built, data mining, AI agents, failed strategies, and so on and so forth. And I talk about, again, capacity and how you build capacity, why it's important. It takes a long time to read through this. Believe me, I've done it a few times. The feedback that I've had has been really, really positive. So if you're interested, I highly recommend going and reading the handbook. It's free, costs you nothing other than your attention for, you know, a few hours. I put some graphics in there as well to explain some of the points that I'm going over. So, you know, there's some things that's a little bit complex. For example, like your probability of ruin. It's good to see it as in a visual way as well. So I really hope that you guys find some value in
Yeah.
that. I've spent a lot of time building that,
It
but also I have
This
my
is
Substack.
all free, by the way, folks. So yeah, please do take advantage of some phenomenal information. It's Kieran spent a lot of time and effort putting this together, and it's all freely available out there.
Absolutely, man. And I'll just like this was published today. So I was talking exactly. I mean, Claude isn't your quant's a bit of a clickbait title, right? But I'm actually talking about how AI agents can work with you to build your portfolio. Again, I've got some graphics in here thanks to Claude Design. All of this stuff is again, like XO said, it's free to read. I mean, of course, it helps me grow as kind of a voice in the space. Which is great for me. But there's so much value in this sort of stuff that I didn't have when I first started. And I feel like if I had it, not that I would have been supercharged because I did pretty well from a curve perspective, but from a knowledge perspective, I had so many gaps that I didn't realize I had. And again, back to my point that I said at the very beginning of this session, I believe in paying it forward. With this, I'm trying to pay it forward to those who ask these questions. What are the bottlenecks? How do I start? Where do I go? I'm so confused. Come and read my stuff. Like, that
Yeah,
that's what you
it's
got to
good.
do.
It's good, yeah. And also, I can advocate the fact that I think when you write about what you do, it just re-emphasizes your purpose and what you're working towards, and it also helps you appreciate any knowledge gaps that you may have. But I'm a big advocate of the saying, "To educate is to learn twice," and
100%.
I think that it's certainly one of the paths that I'd like. I've to some extent I've kind of become bored of discretionary trading, where you're doing okay in trading when it becomes boring, right? And there's only so much shit you can talk about. And so like some days I'm just sat there, at the desk when I'm in a trade, I'm like, I don't even know what the fuck to tweet about today because nothing excites me anymore about what am I supposed to write about, what am I supposed to tweet about. So for me, spending a lot of time on now like systematic trading, and it really makes me want to write about it. Now what's actually interesting is, correct me if I'm wrong, I think you and I actually have different approaches. Obviously, you've been in the systematic side far longer than I have, but I believe that you just jumped in at the deep end and just tried a lot of things, right? Whereas I remember the conversation that you and I had last year was I've probably gone down more the academic route, whereby I've bought a lot of books. I like to listen to podcasts. I like to understand the domain. I like to listen to seasoned professionals who have been there, done it, got the t-shirt, got the badge, and kind of talked through, these are the things that you need to think about. It's actually really interesting that watching you jumping at the deep end and learning as you go along, right? Like you said, you talk about capitalization being one of the hurdles that you've encountered recently, which you've now addressed. For somebody like me, it's like, all right, I'm already aware that this is something that I have to think about, but I haven't got to that point where I've actually have a reason to develop it just yet, if that makes sense, because I haven't reached that stage. So I'd probably say I'm going at a much slower pace, but with maybe a theoretical approach, which I hope serves me well in the long run. Whereas yourself, I believe your approach is far more pragmatic, far more evidence-based, and you're going to get a quicker feedback loop as well, which I hope to achieve now over the next 6 months, now that I'm going to start implementing a lot of the strategies that I've got down on paper that I've been thinking about, and ways in which I want to build these systems. I mean, you've talked about FX Streamer and MQL. I've chosen a different path. I'm going down the path of using Quant Connect, which, again, I come from a C# Python background. So, again, I'm going to be using Claude Code and Codex to help me map out some of those strategies in a code base, which I can then port over into Quant Connect and run the back tests on that. And obviously, I think it's got a built-in risk engine. It's got API gateways to even the crypto markets. I believe you're not actually operating in the crypto space, are you? Is that something that interests you further down the line, or are you pretty much sticking down the path of TradFi and CME futures? And is that more to do with a regulatory aspect as well of what you do?
I I think I said it earlier, and it's a really important way that I run my book is until it's broken, I'm not going to fix it. And I'm not saying that trading crypto will fix it, but what I don't want to do, and I've been victim to this a lot in my past, is when things go really well, I get really excited and then I take more on and I lose my focus on the initial thing that got me the
Yeah.
success in the first place. So what I don't want to do, of course, I've thought about it. I've built some strategies on Bitcoin, breakouts, obviously.
Yeah.
um, but what I don't want to do is split my focus because to trade crypto, it's a whole new architecture. It's not just building a new strategy and running it. I'll need to build new architecture, which will take my focus. Um, so I think that's a conversation that comes when I said it's, when I hit the 10 mil and then it's like, well, what level do we get or what do we need to do to get to the 100 million? That sort of thing will come in there. Okay, do you build a crypto desk within a fund? You know, if I could raise 100 million, then I'm going to be looking at different desks, an FX desk, a crypto desk, equities, all these sorts of things. And that's when I would start having those conversations. Whereas I feel like doing that prematurely, for me, the way that I know and work, which is, relating it back to what you was just saying, I'm a bit of a cowboy. I shoot from the hip and learn along the way. Um, which is great in some regards, but it's also bad because I shoot from the hip and lose focus on my target. And I'm well aware again now the feeling and the weight of the responsibility of my investors. I'm like, I can't afford to shoot from the hip anymore. I have to be more calculated. So yes, I will build a crypto desk at some point, but it's probably in the future.
Amazing. Do you want to talk about some of the qualifications that you're doing? Because you can't just go out there and raise $100 million, right? You've got to, I guess, are you working towards some sort of accreditation as well, or?
Yeah. I am. I am, but I took my eye off the ball, dude,
Yeah,
honestly.
yeah.
So I started working towards my IMC, which is my investment management certificate. And it's funny actually, I was studying for that. It was going really well. I've got until November to complete the qualification. So I'm not saying it's all lost and void, but I started that and then I scaled crazily. Hit a million, hit 2 million, 3 million, and my AUM scaled really quickly. And I was like, oh, this needs more attention and focus than I'm
Yeah.
giving it currently. And then I currently going through a couple of things in my personal life. My dog is on end of life care. My granddad's not well. Like there's a few different things that have had my focus over the past kind of 2 months or so. And so I've took a step back from my studying because I just haven't been in the headspace to do it. But in that time, I spoke to a female I know called Claudia Quintela, who is a professional cap raiser. She did it for Morgan Stanley and UBS, and now she does it for herself. She's done $100 million deals multiple times with managers, i.e., traders, and allocators. I told her that I was doing my IMC, and she gave me the funniest look I've ever seen. And I was like, "What? What's the problem?" And she was like, "Why the hell are you doing your IMC?" And I was like, "What do you mean?" She was like, "You don't need that." She was like, "On it, like you do not need that. You can pass an FCA test. You can work within the boundary of other licenses. Like you can work for example, DarwinX. I can raise capital through DarwinX and effectively work on their white label as such." She was like, "You just don't need to worry about your IMC. Don't worry about it. It's not going to make you money." And I was like, "Oh, okay. Well, that's interesting considering I've already paid for the
Yeah.
qualification and
Yeah.
sunk 100 hours into it." So yeah, I will give it a good shot before November. I will do it because I'm not a quitter. Will I pass? I don't know because I will be the first to admit that I haven't given it the attention that I think it requires. Um, my initial plan was to do my investment management certificate and then go for my CFA and then get my what's it called? IPDM or something like that. I can't even remember what it's called at this point. But things scaled and I had to reallocate my focus and energy elsewhere.
Amazing.
Whether that was the right decision to do that or not, I don't know. We live and learn from these things, but we'll see how things go.
Yeah, absolutely. Well, I think
I'm honest as they come, dude. Like you will always
no,
get an honest answer out of me.
you're a real one. I appreciate you, Kieran. It's you've certainly given me some really great insights over the last several months when I've really started to delve down fully automated systems. So yeah, it's I'm super excited for your journey. Super excited to see where you are in the next 6 months, and I absolutely enjoy reading your content. It's funny because when I talk to other people who are getting into trading, I always mention, why don't you think about systematic trading? Like, hey, there's a guy I know called Kieran. Like, look at his performance. He's only been doing it for 2 years. If you really work hard at it, it should be inspirational, because I think so many people are lured by the prospect of discretionary trading. It's fucking hard. You need to spend several years in discretionary trading. Mm-hmm. You go through emotional turmoil. And even by the end of 5-6 years, who says that you're going to make any money out of it? We really can't talk about the times where, oh yeah, let me buy Bitcoin, and it's, you buy Bitcoin at $1,000 and yeah, look at me, I've made $100,000 in Bitcoin. It was all luck. You were in the right place at the right time. You bought Bitcoin. You try doing that over 1,000 trades. Do you really have a career? Big question mark. Whereas I think this approach, it's not as emotionally draining if you are sensible about the way you approach this. It's almost as if you're an academic, you're a researcher, you're working in some sort of research department, and you're trying to find ways in developing systems that produce profitability. At the end of the day, that's what it comes down to. And so it really puts you on this, if you're very, technical in nature, if you're into software development, if you're, into fixing motors or cars, and you enjoy solving problems, then I think this is a really good, challenging problem-solving skill that if you enjoy being in that mind space, then certainly I think this is up there in terms of not only are you solving problems, but you could be rewarded significantly well if you go about doing it the right way. So, I think for me, the aspects of systematic trading certainly appeal for various reasons outside of just monetary, but it's just the challenge. But also having systems running in the background where it removes the emotional element from my own thought process, and I have a degree of confidence in systems that I can build. Look, for me personally, I think moving forward, it's an area that I would like to talk about in the future. I'm probably not quite there yet, but maybe with some guidance from yourself, Kieran, which I'll certainly be hitting you up on and picking your brains when I hit a brick wall. So look forward to that. But it's been great having you on. Yeah, thank you everybody for tuning in. I hope you found it really helpful. If you have any questions, if there's anything you'd like to ask Kieran, please just tag him on Twitter. I'm sure he'll find some time. You can catch him on his Substack. You can obviously reply to some of the posts that are on some of his articles, and hopefully we can get you back on in, let's say, end of the year. In several months' time, it'd be great to have you back on and see what's been developing since.
Absolutely, dude. Like, a massive thank you for letting me come on with you today. Like I say, it's a bit of a full circle moment for me. So super humbled that to come on and have this chat with you, and hopefully I provided some value to people. And you know me, mate, I'm always welcome to or always willing to come back on and have a chat. We've been here for over 2 hours now. I will talk about this until I'm blue in the face.
That's it.
Probably too much and too fast. So I apologize to anyone who has been listening to my horrible Brummie accent for the past 2 hours.
It's all good, mate. It's all good. But no, thank you. Honestly, I think you've really been a stellar standout account, especially with a lot of the resources on the handbook that you put together, which I thought was phenomenal. It really, really is a great guide. It's certainly something genuinely I wish I had access to 2-3 years ago. It's really difficult finding good information when you're starting out in this space. You have to sift through a lot of bullshit. You have to kind of ignore the propaganda that you see pushed on YouTube by influencers talking about, oh, look at this automated strategy. I'm making X amount of money. Why do you copy trade me? You copy trade them. You piss your money away. They've made a fuck ton of money through commissions. They're the ones that are getting paid by selling you a pipe dream and a false dream, I should say. And that's the reality. Nothing comes easy. So if it sounds too good to be true, it probably is. And just spend a lot of time and dedication, and hopefully you'll be better for it. But thank you everybody for tuning in. Thank you, Kieran. I wish you all a great, blessed remainder of June and a very prosperous Q3. Hopefully we'll catch you on the other side in July on another stream. Take care. Thank you.